Hi, everybody. Brian Foote here with a quick update and a quick answer to a question that has come up. The question is, can value investing, convexity investing, be applied to small capitalization stocks, small cap stocks? The answer is resoundingly yes. And in fact, some of the greatest mispricings occur in the small cap world. Companies with market capitalizations really sub $250 million, you get some amazing mispricings. And as a result, the ability to generate extremely convex returns. There's a few reasons for this. One of this is that, number one, the companies that are smaller are not as well researched, right? If you think about it, you and I are up against very large institutions. The larger the institutional investor, we're talking mutual funds and larger hedge funds, the larger they are, the less impact a smaller cap company would have. Think about a fund that's running even $1 billion. If they find a company that they're very interested in that, say, has a market cap of 100 million, if they go and buy 10% of that company, which will be a very difficult thing to do, that's only $10 million. That would only be 1% of their portfolio. So having been there at a larger fund myself, I was often finding these great small cap ideas, but unable to put them into a multi-billion dollar fund, not because they weren't interesting ideas, just because they wouldn't make a difference. Secondly, the small cap stocks, partly as a function of the first thing I mentioned, is the smaller trading volume, right? That's not terribly relevant if you're running a portfolio of single digit hundreds of thousands of dollars, even up to single digit millions of dollars, right? If you're running a smaller portfolio and you find a great idea, it's very easy to go in and buy something that trades tens of thousands of shares a day. If you're a larger institution on the buy side, again, a mutual fund or a hedge fund, it's frustrating to try to get in, and also to get out of a position that doesn't trade high enough volume. Rules of thumb exist, right? But generally, the smaller the capitalization, the lower the trading volume. For smaller investors, even myself professionally, not running billions of dollars at this point, I don't really mind lower volume trading days. The other thing that makes small cap stocks such an interesting thing, right? So you have less competition from the big guys, and you have less of a problem with volume. You have more time as a small investor with management teams, right? The bigger companies are typically going to have an in-house IR director or maybe an entire team of investor relations people. Smaller companies, you'll find the smaller they are, the more apt they are to take phone calls from smaller funds like mine, or even individual investors like you, that you can get a better picture of what they're up to, and often some edge. Nothing that's illegal or unethical there. Just the fact that you can get to know a management team much better when they're smaller capitalization. The most important thing, I think, is just a mathematical thing, right? If you're looking at $100 million company, you can grow that $100 million business into a $10 billion thing, mathematically, right? And have 100 times a return, right? There's many cases of companies between 50 and 100 million growing into 5 billion to 10 billion, which would really put them just into the mid cap sort of environment. There aren't too many. I don't think there are any examples of a $10 billion company turning into a $1 trillion company, other than the few $1 trillion companies we have out there. But right, you can run the numbers. I have not lately, but I could tell you your chances. Just again, mathematically, we're not talking about what kind of company it is, but $100 million companies do grow into $10 billion companies with far more frequency than trying to go and be to grow a $10 billion thing into, say, Berkshire Hathaway, right? 900 billion plus market cap, right? Or Apple, over $1 trillion, or Microsoft, right? The next Microsofts, the next Apples, the next McDonald's type companies, and even potentially the next Berkshire Hathaway are hanging out and lurking in the in the $100-200 million range. And again, this is just mathematical truth. It's not anything that is terribly scientific. But if you think about it, there aren't too many $1 trillion companies out there, but certainly there's a lot of $10 billion companies and a lot of $5 billion companies that at one point were $100 million things. So does small cap investing lend itself to value and convexity investing? Well, value, yes, you're going to find a whole bunch of great ideas in the sub $250 million market cap range because of what I just said, right? Limited competition, lower volume, and just less interest from big guys, so less aptitude to be overvalued. And the second, how do you get a convex return? Well, you buy things that go up 50, 100 fold, right? And so turning $100 million business into a $5 billion business, there you go. There's your 50 bagger. It's not easy, but it's not very complicated either. And while I don't know what they are, I can tell you that lurking among those $150 million things are things that in 15, 20 years could be 100 baggers or 50 baggers. So that's where you'll get your convexity. Thanks for joining, and we will be back with more.